I think the economy overall is weaker than widely anticipated here. I think
I don't need to ask my tax man. I don't need to go to a consultant. I don't need to speak to my accountant. I can do it myself. That's why people are worried about this stuff.
Foundation as far as the economy, where valuations are, markets are really struggling to find a new narrative here.
More importantly, we haven't seen the consistency in earnings that I think people are missing. I think at the end of the day.
Technology here.
Yeah.
Software as a service. Boy, they took a hit on the chin there over the last several weeks.
Well, there is a massive difference between the weather and the climate, and frankly, I don't think people are really getting that, right? So the weather, I want you to think about it like this. That's the news that we see every night on TV, right? It's the daily up and down of the S&P 500, or like maybe the quarterly earnings beat of a tech giant, Apple or Nvidia, right? Okay, well, said differently, it's the latest inflation print that's tucking you in at night and it's telling you that, everything's fine. But let's be honest, it's not fine. I mean, just look around. What are your friends who own businesses saying? Not great for sure, right? I don't see, RV and boat sales out there crushing it. But boy, oh boy, right? When the economy's humming, that is exactly like the two corners of the market that I'm looking at. And you know why? Because entrepreneurs, they love spending money that they don't have. They love taking on long-term debt because 1 year of solid sales numbers is the promise that next year is going to be even better, right? That promise is broken right now, right? Acting like the economy is healthy just because the S&P is up is like the financial equivalent of that little cartoon dog, right? You know the one that I'm talking about. He's sitting in a room like this, only he's engulfed in flames, and he's holding this little coffee mug, and he's staring like blankly ahead, and he's like, everything's fine, right? That is the American business owner right now, right? The walls are literally melting down. Insurance, by the way, is up 22%, which is insane. But hey, soft landing, right? Everything's good. Everything's fine. Dow's at an all-time high. S&P is all-time high. But the climate, right? That is what you actually feel once you put that coffee mug down, right? It's the cost to hire a welder. It's the price to insure your warehouse in Florida. And by the way, it's the speed in which your customers are paying their invoices, which, let's be real, slow. That is how I would best describe their speed. Very slow. In fact, painfully slow. Maybe even strategically slow. Because guys, let's not be naive here, right? If they can sit on that cash and earn 4% in a sweep account for another month instead of paying you, yeah, rest assured they're going to do it. And effectively, you've now become a part of like their capital stack, and you didn't sign up for it, but you're in their stack. You're financing their business. And it almost seems like a Ponzi scheme, doesn't it? Old investors get paid with new ones or whatnot. I mean, it is an absolute mess. Or like that cartoon, everything's fine. But look, I want to get back to the report. So listen, for the last 18 months, the weather has been improving, right? I think we can all agree on that. Charts look great. But the climate for private business owners, I think it's become increasingly hostile. And frankly, what is today? Thursday, February 12th? I'm recording this because there is a dangerous complacency, and it's settling into the American marketplace right now, where we're hearing that everybody relax. The storm is past. We've made it. Everything's fine. But at Cardiff, we think our data says the opposite. And if that scares you, well, don't change the channel, because we are the largest privately held commercial finance company in the country, which means we don't model our outlook based off of, bullshit sentiment polls or what some talking head on CNN is shouting about. We model it based off of billions of dollars of actual flow, real money. And what we're seeing is like a structural divergence, which, let's be real, even I had to look that one up. Shout out to the producers. But basically, it's like this great separation, right? Where the cost of capital for let's say the Fortune 500 is falling. It's less expensive, but then the cost of survival for Main Street businesses is rising. This isn't about being a pessimist, because look, I am an optimist on American businesses. I am pro-American, right? I wouldn't be in the seat if I wasn't. But optimism isn't a strategy. Math is. And right now, the math on Main Street Well, it simply just doesn't math. So we released our first major report of 2026. We call it the Private Recession. And I want to walk you through the reality of this thing point by point, because if you're building your budget based off of some Wall Street optimism, you're already behind, right? You're losing before the starting gun goes off, right? There are three specific lies that I think the current headlines are telling you. The first lie is about interest rates, right? Well, so the prevailing narrative right now is that the Fed has done its job because they've cut rates down to the 3.5% range, and the market's celebrating, right? They're popping champagne corks. But if you're a private operator, I want you to ask yourself a simple question. Has your cost of borrowing actually gone down? Has it? Has it really? Likely the answer is no, it hasn't. Now for a Fortune 500 company, right, who can issue bonds, yeah, capital's gotten cheaper. Great, good for them, right? Golf clap. But the small and medium-sized businesses, guys, the effective cost of capital hasn't dropped. In fact, it's likely risen. So we are seeing a historic expansion in credit spreads where while the risk-free rate has actually come down, the risk premium lenders are charging private businesses has really gone up about 150 basis points. So while the news talks about 3.5%, the reality for like an equipment loan or working capital line of credit in the private market, right? The money you actually use, Mr. Entrepreneur, is likely stuck between 9.5% and 11.5%. That right there is the prime trap. So if you're waiting for cheap money to save you in 2026, you are going to be waiting a long time. Think DMV wait time, right? Because the neutral rate for private businesses has structurally reset. So do not model for 4% money. Forget about it. It ain't happening. Model for 9% and build a business that works there. The second issue is what we're calling the shadow tax, right? Inflation is technically cooling down, right? CPI is down to 2.6%, which, listen, sounds great on paper, but the CPI is an average and you don't pay bills with averages. You pay bills with specific dollars. And the specific inflation baskets that kill small businesses, what are they? They're insurance and energy, logistics. Are those cooling? No, those are accelerating. Look at this. Look at commercial property insurance, because despite all the headlines, right, that are talking stabilization, flattening, we're seeing deductibles and premiums for coastal markets. Think West Coast, East Coast, up 22% year over year. That is a massive hit. That hurts. That hurts your bottom line. So if your revenue's flat, insurance costs go up 22%, that is pure margin erosion. That's a hole in your EBITDA that you're not going to sort of wiggle your way out of. You cannot efficiency your way out of this, right? And then you have tariffs, where the data that we have indicates that supply chains bracing for peak pass-through in the second quarter of this year, which is right around the corner. This creates a scenario where a business can look healthy on the top line. Great. Vanity metric. Tell all your golf buddies, right? Sales look great. But you're bleeding out on the bottom line due to non-interest fixed costs. And this leads me to the third and probably, I would argue, the most critical point, which is like the productivity paradox, right? You can't open a browser without hearing about the productivity boom since we saw this massive, almost 5% surge in labor productivity late last year. Everyone's talking about it. But here's the truth. The boom is K-shaped, right? Who are the winners, by the way? The winners are the massive enterprise firms who are using AI and automation, by the way, and they're stripping out all the costs and they are able to boost output. While who are the losers? Service-based small businesses, local manufacturers, or your local logistics company. Main Street businesses, mom and pop businesses aren't seeing this AI efficiency boom yet. But Main Street is actually seeing wage inflation that comes from it. You're being forced to compete with talent against large companies that are using AI, which ultimately drives up wages. But if you haven't deployed those tools yourself, you're paying 2026 wages for like 2019 productivity, right? The large companies are stealing all the good talent. So that mismatch is crushing unit economics because you can't pay AI wages for analog output. It simply doesn't work, right? The math breaks. So what's the real result of all of this? The result is the number that nobody wants to talk about, 11%. That is the year-over-year surge in subchapter 5 bankruptcy filings. And for those of you that what is he talking about? It's the specific filing for small businesses, right? It's the Main Street bankruptcy. And 11% isn't like a rounding error. It's not a statistical error. It is a signal, beep, beep. And it's telling us the buffer's gone. The lag effect of tight capital is finally breaking the balance sheets of the bottom 50% of American businesses. Meaning like companies that relied on cheap debt to mask low margins are finally being flushed out. So you're like, well, Will, where do we go from here? Well, if you're a CEO, if you're a founder, if you're a CFO, what do you do with this information? First, you got to stop managing for the weather. Stop watching the Fed on CNBC. Stop talking about the S&P 500. In fact, turn the fucking thing off. Turn off the TV. Start managing for the climate, right? You need to accept that the cost of capital is going to stay high. So if you have access to liquidity right now, great, congratulations, take it. Don't wait for some better rate that could come in Q3 because liquidity is king in a high friction environment like today. Grab it while you can. Second, and maybe this is even more important, you have to pass the price, right? We talked about shadow tax, right? That 22% insurance hike or even the tariff costs. You cannot absorb those, Mr. Business Owner. You got to pass it to the consumer immediately because if you're afraid to raise prices in this environment, well, you're choosing to be a philanthropist, not a business owner. Because if you're afraid to raise prices in today's economy, you're acting like you're a philanthropist, but you're not. You're a business owner. You don't wear a tuxedo and go to these fancy events. You're not a philanthropist. You're a small business owner. And frankly, you can't afford to be a philanthropist anymore. And finally, you got to fix that productivity gap, right? You cannot wait to automate because if you're running a manual shop in a digital wage environment, you'll be priced out of the labor market by the end of the year. At worst, maybe even sooner. Look, American small business is the most resilient force on earth, right? We have survived wars. We've survived pandemics. Boys, we've seen it all. We will survive this private recession too, but we're not going to survive it by pretending it isn't happening, right? Don't close your eyes and just hope for the best. That is not a strategy. We are heading into a year where the separation between operators who respect the math are going to capture more market share. And then the operators who are waiting for the old world to return will go the way of the buffalo. And it's really that simple. So read the report, understand the data, and let's get to work.